So, you know, housing market, you know, they say it's getting better. I'm not so sure, but, you know, certainly there are signs that the economy is improving. How is that not a good thing for housing?
It does seem counterintuitive, but the big thing is, think about it, and Dave and I were talking earlier about this, and just in, you know, housing markets and where we live. So much depends right now on where mortgage rates are. And what we've seen over the past 2 weeks is this really steep backup in Treasury bond yields. And that's because people say, hey, the economy's getting better. This is crazy to have the 10-year Treasury yield at 2%. But of course, the mortgage rate keys off the 10-year. So what we're seeing now is mortgage rates creeping up. It's not like they've zoomed yet. But given that the mortgage market and the housing market wasn't doing that good still with mortgage rates at 4%, if mortgage rates go up to 4.5%, that's just another pressure.
I want to bring in a Wall Street man, Wall Street columnist for Market Watch, right? So here's my theory: is that and I've been told this, is that the lending by the banks hasn't been very robust, no matter what the price. Right. So it almost doesn't matter what the price of the mortgage is. So does that sort of go against that idea that higher rates? I'll
let David answer, but no.
David, answer.
I don't think
with that in mind, answer.
I don't think for qualified borrowers it is that hard to get a loan these days. And part of it is because there is pressure from the government on these banks to make loans.
Oh, they're finally doing it, right?
Well,
but let's be clear here. It's not a question that the banks are saying, oh, we're just not going to lend. Banks are actually, get this, they're saying you have to have 20% down. Yeah. You actually have to show us that you have an income. Oh, yeah. You have to have a decent credit score. And I love how it was not doing all those things got us into a housing crisis. Now people say, oh, those banks, they're making you put 20% down. Well, of course they are.
But I've heard anecdotal stories of people with, you know, with great jobs, long job history, 20% to put down, you know, 850 on a credit score or whatever the highest number you can get is.
And these are the same people who always win at the casino, right? You never hear the bad stuff. Look, banks out there right now. I mean,
anecdotes like
because
that.
most banks out there right now are not making a mortgage and keeping it on their books. They're just if you have someone like that, you got an 850 credit score, you've got 25% to put down on a house, you've got a good income, you can meet your payments. The bank can make that loan and turn around and sell it to Fannie or Freddie. There's not a risk there for them. They're not going to sit there and say, well, we're not going to do that. But there is a question: is what's the house actually going to appraise at?
Right.
Do we really think that your income is steady? You know, it's not just the banks are actually trying to be conservative in their lending, and you know what? They should be. So within all this, if the mortgage rates go up, affordability is still a question. Especially not for the person who has, you know, a huge down payment, but for the first-time home buyer, and that's a key part of the market.
And that is a key part of the market because it's what keeps things going around and around and around.
Yeah, and I would say that the problem isn't so much bank lending as it is the last 10 years and the way it's geared. David and I were talking about this earlier. The way it's geared the homeowner or the home buyer's sort of psychology in how they approach what price they're going to get for their home. And the reality is that home prices have come down. So people are very, I am buying a home and selling a home right now. And the one thing I've learned is that, you know, the homeowner just does not understand what their home is worth. They may have put a lot of money into it. They may have spent a lot of money on it. And the reality is that home prices are low. And that's a very hard decision for some people to make or to kind of get their mind around.
Now, you mentioned the 30-year, which is the fixed rate.
Right.
What about the variable rates? Are we seeing lending on the variable rate side, the 2-year fixed with the
There's still a very, very small portion of that. Because look, I mean, a variable rate, there's certain instances where you do the math and it works. But for most people who don't want to get fancy, if you look and say, okay, over the next 10 years, do you think rates are going to go down or up? I think most people would say rates are going to go up.
But the Fed says that they're going to keep rates near zero until the end of 2014,
right,
which is quite a while.
But Simon, you have such a short-term mentality. See, isn't this the problem with housing that we had a couple of years ago?
Sorry, can you say that again? I forgot what you said. What did you say?
Most people go into a house, you know. Dave here, he's not thinking I'm buying this house for the next 2 years. He's thinking I'm buying it for the next 10 years, which itself is a change in mentality from 5 years ago.
Yeah.
But so he's looking and saying, boy, do I think that mortgage rates are going to be at 4%, 4.25%, 10 years from now? No, of course not.
Yeah, you would have to grab the rate now. I mean, there's no point in doing, unless you're going to flip the house, which is dangerous anyway.
As rates go up, don't house prices come down, rather like a bond? Right?
Right.
Isn't that
Well,
what's going to happen? If we
that's-
get a 10% rate on mortgages, aren't houses going to be, you know, like $50,000 each?
Well, no, not that low, but it does put price pressure on it. And
Yeah.
one of the
So
things,
shouldn't I wait? Shouldn't I wait then until rates go up and then buy?
well, no, because here's the thing, because you're going to just have to, it's going to equal itself out or cancel itself out because you're going to be paying a higher rate, so the price and the rate cancel each other out. Here's the strange thing, though. The real risk isn't just that rates are creeping up, but that we've seen such a quick move in rates. Because normally when people think rates are going up in a sort of steady progression, they say, let me get in and buy now. And that can actually spur more housing activity. But if you get a sharp jump, say, 4 to 4.5% in a month or two, that just really, freaks people out. And they're like, wait a second, I don't know what to do with this.
Is Ben Bernanke pulling at his beard with worry because of this spike in rates?
I think hugely, because look, the Fed has been trying to keep longer rates down, but in a lot of ways that's because they want to keep mortgage rates down because they want to help the housing market. As you guys were just saying in the last segment, we haven't seen a post-World War II recovery that hasn't including a housing recovery. And the Fed has thrown the kitchen sink at the economy. It hasn't come back the way they wanted. So over the past 8 months, Ben Bernanke suddenly said, how can this be? The models are... It's housing, so we have to do something about housing. Last thing he wants to see is, rates suddenly spike up. People say, oh, I can't afford a mortgage, I'm not going to buy, and the housing market weakens.
You could say it, QE3.
Well, I don't know if it'd be directly QE3, bond buying, but maybe they do some form of it.